Hello, everybody, and welcome. So we're going to go through today some depreciation questions, starting with double declining balance. So my name is Bennett Tchaikovsky, accounting professor here on YouTube. His presentation is 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any redistribution is expressly prohibited by myself, and any opinions contained herein are those of myself and not my employers, including but not limited to Irvine Valley College and the South Orange County Community College District. So let's go ahead and take a look at our very first question here. So we've got YYZ purchased equipment for 600,000. The equipment cost 50,000 to install, $70,000 to ship, and then there was $20,000 spent on initial testing and calibration of the equipment. And so we're told that the equipment is expected to last for 6 years and will have a $260,000 salvage value. Assuming that double declining balance is used, determine the depreciation expense for the following periods. So we're going to go ahead and start with this one. And when we're going through and dealing with double declining balance, what this really is an accelerated method of depreciation. And if you kind of look at what can be seen as a justification, excuse me, basically of the accelerated method of doing depreciation is, what we're really doing is we're taking more depreciation up here and then less over time. So we're going to take more depreciation first, as opposed to something like straight line, which basically has the same amount of being taken every single year. Now, with double declining balance, just think about it as like a BMW or BMW with no protection plan. I'm saying that lovingly. My wife is a huge fan of their cars. I can't stand them, but my wife likes them. Okay. So, but in any event, what we're going to go through and do is for this particular question, how do we compute depreciation expense under double declining balance? Well, normally, if we were doing straight line, it would be acquisition cost minus the salvage value divided by the estimated useful life. But since we're trying to do an accelerated method, what the formula is going to be is going to be the acquisition cost minus the accumulated depreciation or the accumulated amount of depreciation that I've taken to date. I'm dividing this by the estimated useful life. And because it's double, we're multiplying this by 2, or you'll sometimes see this written as 200%. So this would give me my annual depreciation expense using double declining balance. Now, when we're going through and doing double declining balance, we have to be very, very careful, because one of the things we can never do is we can never have our net book value or the acquisition cost less the accumulated depreciation. This is what is known as our net book value. The net book value can never fall below the salvage value. So what we're going to need to do for this and any other type of depreciation question is we're going to have to make a little chart. And so we're going to come over here and we're going to go through and do a chart. We're going to have our acquisition cost less basically the depreciation expense. We're then going to determine accumulated depreciation. The net book value will be our acquisition cost minus the accumulated depreciation. And this is going to give us our net book value, or NBV. Okay, so now with the net book value, we're going to be going through and comparing that to our salvage value, or D. Okay, so as long as C is greater than D, we keep depreciating. keep depreciating. Okay, so that's kind of going to be our approach for these different questions that we're going to be going through and doing. So as we go through and look at this, this is really going to help us say, do we keep on going? But let's kind of put in what we know. We know that our salvage value is 260,000. And let's now figure out what our double declining balance is. So the way we determine our acquisition cost is going to be the cost to get the asset ready for its intended use. So it's any cost that we're going through and spending, essentially trying to get that asset ready for use. So when you see we purchased equipment, 600 grand, sure, that's part of the acquisition cost. 50,000 to install, yes. 70,000 for shipment, correct. And then 20,000 for calibration. All of these costs here are what we would consider to be acquisition costs. So our total acquisition cost basically of this equipment is going to be the 600,000 purchase price, 50,000 installation, 70,000 shipment, and then the 20,000 initial testing and calibration. Remember, this is not ongoing maintenance. This is something we need to go through and to initially start. So our total acquisition cost basically for this item is going to be 740,000. Now, once we have this over here, we can start with 2027. So 2027, our acquisition cost, so 650, 70, 20. Okay, so our acquisition cost is going to be 740,000. On this day, we have taken no accumulated depreciation to date. However, the equipment is going to last for 6 years, which is our estimated useful life. And then I'm going to multiply this result by 2. So this is going to be 740,000 divided by 6 times 2, or a nice unround number. So that's my fault. Okay, so we get 246,667. We'll just go with it. Now, when it comes to this part over here, what I need to ask myself as well, this is annual depreciation expense. How long did I use it for in 2027? Well, I didn't use it for a full year. I used it for 4 months, September, October, November, December. So I need to multiply this result here by 4/12. So 246,667 times 4 divided by 12 is going to give us 82,222. So over here, our acquisition cost is 740. This is never going to change for all of these years. Our depreciation expense is 82,222. Now, remember, when we record depreciation expense, we're debiting depreciation expense and we're crediting accumulated depreciation on that equipment. Remember, it's the same as straight line. We're just doing a different methodology, right? So my accumulated depreciation at this point is going to be 82,222, right? Remember, depreciation, revenue, expenses, revenue, and dividends all are closed out to retained earnings. Accumulated depreciation is a contra asset account. So when we come over here, so when we compare this over here, we go to our net book value is going to be the acquisition cost minus the accumulated depreciation, or 657,778. So we can keep on depreciating because this is ahead of our salvage value. Let's go ahead and go to 2028 and give ourselves some more breathing room in the meantime. Okay, so 2028, we have 740,000 minus the accumulated depreciation of 82,222. This is going to be divided by 6 and multiplied by 2. So when we're going through over here and doing this particular question, okay, so this is going to give us, it's basically going to be our net book value, or 657, 778 divided by 6 times 2. So this will be 219,259. We used it for the full year. So right over here, our depreciation expense for 2028 is going to be 219,259. Now, my accumulated depreciation, right? So what was in the account? Well, basically after that very first year, so accumulated depreciation as of 12/31/27, it had a balance of 82,222. When I came over here, the ending balance as of one year becomes the beginning balance of the next year, because this is a contra asset account. It is not closed out to retained earnings. So over here, this becomes my beginning balance as of 1/1/28. This is the amount I took in terms of depreciation expense. So my ending balance and my accumulated depreciation is going to basically be over here at 301,481. Okay. So over here, now my net book value is going to be 438,519. Can I keep on depreciating? And the answer is yes, we can keep on depreciating because the net book value is greater than the salvage value. So let's go to the next year. When we come over here to the next year, or 2029, so this is going to be 740,000, and this is going to be minus over here 301,481, or the amount of the accumulated depreciation. Well, let's just put some commas in there to make sure we're doing this correctly. Okay. So we've got 740,000 minus the accumulated depreciation, or the total depreciation taken to date. We're dividing that value by 6 and then multiplying it by 2. So over here, this is going to be, my value here will be 438,519 divided by 6 times 2. So right over here, my value is 146,173. So the amount of depreciation I'm going to take in 2029 will be 146,173. What this means is my accumulated depreciation, right? So my ending balance as of 12/31/28 was 301,481. If I go through and take another 146,173, my new ending balance, or the total amount of depreciation I have taken to date, is going to be 437,654. So my net book value is now going to be 292,346. Now, as we kind of go through and look at this, we're kind of getting close. What does that mean? It means that the salvage value is still less than the net book value. However, we got to keep an eye on this for in the event we basically over depreciate. So remember, we can never depreciate beyond an asset's salvage value. So let's go over here to 2030. This is going to be 740,000 minus the accumulated depreciation, or in this case, it's going to be 447,654. I divide this value over here by 6, multiply the result by 2. So over here, my 292,346 divided by 6 times 2. This is going to be 97,449. So I would tentatively come over here and say, okay, we've got 97,449. And I look over here, I've got 545, and my net book value is 194,897. I have a problem. The problem I have here is my net book value is greater than my salvage value. So what I'm going to need to go through and do is to come over here and basically say, okay, this is a big no-go, right? So this is a big no because we've over depreciated the asset. So what I'm going to do is I'm going to say, okay, what's the most amount of depreciation I can take? I'm going to go to the prior year or 2029. I'm going to look at the net book value, 346, minus the salvage value or 260. I'm going to subtract salvage value from the net book value, and I'm going to get 32,346. And I'm essentially going through here and manually determining the depreciation, right? I'm basically saying, okay, I'm going to do too much. So we're basically going to have to, they sometimes will call it force, but that's not the best way to put it. But it's basically whatever you're going to basically do so that the net book value equals the salvage value. And so after we depreciate for 2030, we stop depreciating. Okay, so coming right over here for 2030, the amount of depreciation we're going to go through and take is going to be 32,346. This is going to give me 480,000. And so I get down to this 260. So the answer over here is basically for these questions is going to be 1231.27. The amount that I would take is 82,222. Go to the right one. Then I'm going to have 219,259, and then I'm going to have 146,173. Now, if I asked you to go through and to do year ended 12/31/31, you would say over here, which I will change this problem to do this, it's going to be 0. Why is it 0? Once an asset has been fully depreciated down to the salvage value, where the net book value equals the salvage value, we have to stop depreciating the asset, right? So that's how we kind of go through over here and address these different questions. So let's go through and now take a look at this question down here, which kind of tags along with what we were doing up here. So in this particular question, or I should say for this particular assumption, okay, so right over here. So this was the solution to the problem that we just went through and did. But it says assume the same facts, except that on 1/1/29, that the equipment will last for 8 years beginning on 1/1/29. Determine double declining balance for 12/31/29 and 12/31/30. Okay. Now, when we have a change in estimate, right? Remember, when we look at this formula, acquisition cost is really the only real number, right? It's the one that has certainty because that's what we paid for the asset to get the assets ready for its intended use. Salvage value is an estimate. It's basically what we expect to sell the asset for at the end of its useful life. Estimated useful life, it's an estimate. But can estimates change? And that is the answer is sure, because as we get better information, we're ready to go. So when we look at this, assuming the same facts above, except that on 1/1/29, the equipment will last for 8 years beginning on that date. So the important thing is we're doing this as of 1/1/29. So I'm not going to go back and change anything I have gone through and I have done in the past. I don't change the past. It may seem a little bit unrealistic because say, well, Jake got Tchaikovsky. It's like you changed it, but we're saying basically on 1/1/29, we're not going to mess with what we've done in 2028. So we're going to basically so we basically are going to come over here. And what we're going to do is we're going to use the new information. So let's go through and do this. So we have 740,000 minus the accumulated depreciation, which was 301,481, which was basically that accumulated depreciation at the end as of 12/31/28, right? So again, we're not changing any of the past. We're only going to change things in the future. Now, instead of dividing this by 6, right, this is now going to be lasting us for 8 years, right? So I'm going to divide this by 8 and I'm going to multiply this by 2. Okay, so coming over here, my net book value is 438,519 or 740 minus 301,41. I divide this by 8 and I multiply it by 2, or I get 109,630. That means my accumulated depreciation now is 411,111. So my net book value is 328,889. So I'm still okay, at least for the moment. So for 2030, what I would go through and do is I would say, okay, we've got 740,000 minus 411,111 divided by 8 times 2. So this over here is going to give me 328,889 divided by 8 times 2, or 82,222. Huh. So pure coincidence. Okay, so over here, my total accumulated depreciation is 490, 493, 333. Now, when I get to this, I've got a problem, right? What's the problem? Is that after 2030, I didn't even realize I did this when I wrote this question, but this is kind of nasty. I over depreciated the asset, right? So what do I need to go through and do? Well, I'm going to have to do the same thing I did previously. The most amount of depreciation that I can go through and take is going to be the difference between basically the net book value and the salvage value from the prior period. So I'm going to go ahead and take 68,889. My accumulated depreciation is going to be the prior year ending balance of 411,111 plus the 68,889. So my net book value over here is going to be 260,000, which is equal to the salvage value. So coming over here, my depreciation expense for the year ended 12/31/29 with the new information is 109,630. And then over here, it's going to be 68,889 because I had to manually determine the depreciation, because if I used this value here, I would end up over depreciating the asset. So that takes us through double declining balance for today. Thank you for joining me. I look forward to seeing you on the next video. Have a great day.